In today's morning brief, our Brian Sozzi says that investors should fight the Fed at their own risk. Given the Fed's continued hawkish stance since the June meeting, the possibility of further rate hikes is strong. So should the bulls rein it in? Seems like they have a little bit now. The market, while down the last few days, has remained resilient in the face of negative surprises like the regional bank crisis, I should say. Goldman Sachs strategist David Kostin wrote in a weekend note that stocks with quality attributes should outperform even with tighter monetary policy. We have Brian Sozzi with us for more on all this. We're also bringing back in Tony Dwyer, Canaccord Genuity Chief Market Strategist. So fight the Fed at your own risk?
Yeah, fight the Fed, get clubbed over the head. And I think Tony was really on point. Will bring to light this economic slowdown we are in fact experiencing. So you take that economic slowdown and you have a Fed just about a week and a half ago, 2 weeks ago, telling investors, a pause does not mean we're done raising rates. And as you go around Wall Street, you have a lot of folks, I think, now worried about 2 more rate hikes this year, not 1, 2. And that is a big change in sentiment and market expectations just compared to a month ago that sent all these AI stocks to records, set NVIDIA stock to over $1 trillion market cap. So there's been a change in sentiment. And I think the market is still trying to adjust to what the Fed may do in the back half of the year. And you can fight it at your own risk. But a lot of folks I'm not talking to in the street are now trying to get a little more defensive, position clients a little more defensively, dividend payers, safe balance sheet type companies. So rotating out of some of those riskier areas into more safe haven plays.
I mean, Tony, it feels to me not like the Fed changed its message, but that the market finally just started listening to what the Fed was saying. I mean, all these people pricing in a hike before the end of the year, that was not the message that the Fed was ever putting out there.
Yeah, to Brian's point, a lot of folks are now starting to talk about the defensive behavior that we've been anticipating that's really actually taking place in the average stock. The thing that blows me away, Julie, is that people keep referring to what the market is saying, even though the market has been dead wrong on what the Fed is going to do over the course of the last year. Like I look back at the middle part of last year, and the Fed funds future peak rate was expected to be 3.25%. So the idea that we're going to look at what the market's expecting and somehow extrapolate what the Fed's going to do kind of is bananas. So to me, when I look at what are the market, the optimism in the market is surrounding this rolling recession or soft landing environment. So what I did is I looked back at the 2 prior soft landings that we've had, which were 1966 and 1995. And it's not like it just came from magic. Those soft landings were generated because there was an amazingly fast drop in interest rates and short-term interest rates that created a steepness in the yield curve that increased the outlook for money. In other words, by making it more profitable for institutions to be lending. We're not, obvious to Brian's point, we're not seeing that. We've seen this elevated level of short-term interest rates. So the catalyst for a real market rally or a soft landing comes from short-term interest rates because it improves the outlook for money. And that is obviously not present today. We're 126 basis points on short-term interest rates higher than we were from the October low of last year. And that's just so different than what happened in any prior soft landing or soft landing market recovery.
Tony, it feels like the market is it's hanging tough because the fourth quarter by this year, you might see a real acceleration in earnings growth. S&P 500 earnings maybe grow between 8 and 9%. But if we do, in fact, get 2 more rate hikes, is this just a market that is just clinging to too much hope about corporate earnings power?
Brian, I really go back to, there has been a little bit of broadening, but what market are we talking about? You've got more than half of the S&P sectors that are down for the year. The Dow Jones Industrial Average is only up 1.75%. The Russell 2000 small and mid cap indices are up small single digits. So it's not been a robust year. And I think that's the challenge for folks like us to talk about is we're gauged by the S&P 500. That's the major market that, okay, is it a good year or a bad year? But that's really that based on those mega cap tech stocks, which dominate the NASDAQ composite and NDX as well. Those are really the ones that are up. So you've got this extraordinary movement in those stocks. And, the debate becomes, will that mean that the broad market plays catch up? Again, Brian, I go back to what happens with short-term interest rates. Like I'm typically kind of known as the perma bull and the guy that's the most optimistic. And it's no fun being cautious, but there's a reason for that. You should be a perma bull when the money's widely available and growing because it's a leveraged system. And to me, I've always been really bearish when the money is shrinking and the outlook for money is not improving, because that's what creates that ultimate earnings decline, which ultimately I believe is going to come.
Tony, you don't sound like a perma bull right now. Look, there's a factor of market psychology that comes into play, and we've recently seen this kind of FOMO situation happening in terms of market action and investors getting bullish and following the trends. How can you say not you're like getting in front of a moving train? It feels like.
Well, you don't have to bet against it, Diane. There's this great idea that if you're not long, that must mean you're short. How about you get? So here's the way that I think about this in the broad market, which answers all the questions, right? I'm not betting on the downside. We're already a year and a half into this, and the average stock is already down pretty significantly from a 52-week high. But if you use my $210 estimate, which is well above some of the more bearish estimates, but below the current consensus, if you use my $210 earnings estimate for this year, and for the viewers, if you use the earnings yield, which is the inverse of the PE, so it's the EP, that gets you an earnings yield based on current prices of about 4.75%. As I look over at my screen, I got a 6-month T-bill at 5.4%. So I got a riskless rate of return for 6 months of 5.4%. with a risk rate of return of 4.75%. It doesn't mean you have to bet on the downside, but in that scenario, I don't exactly see why you want to bet on even more risk after you've already had that FOMO rally.
What unlocks the upside for stocks?
One thing, Julie, and that's a significant drop in short-term interest rates that re-steepens the yield curve and incentivizes the outlook for money. Remember that we typically see a bear market low in a recession. And it doesn't make sense to a lot of individual investors. Like, how could you bet on a recovery in the middle of a recession when you know that things are negative? And the answer is because short-term interest rates have come down enough that it is really incentivizing lending institutions to provide more money. That or for households to refinance or corporations to take out more debt. I mean, high yield debt is actually up to 9% again. So I get it. Credit spreads are a little bit narrower and they don't suggest a recession. Tell that to a company that's raising money in the high yield market. Mortgage rates remain high. All those things that are tied to short-term interest rates are still suggesting that you shouldn't have this big boom in economic activity. So it's a very long-winded answer to short-term interest rates must come down, and I will change my tune at that point.